2024 has been a year of economic resilience and stock market records. The Dow, S&P 500, and NASDAQ all up double digits for the year as of mid-December. But what's in store as we head into 2025? Joining me now, Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. Liz, great to see you again, Liz Ann.
Nice to see you too, Jack. Thanks for having me.
Sure thing. So let's talk about 2025. In your most recent report, you poke fun at this idea that Wall Street hates uncertainty, but you point out that it's always uncertain. In fact, right. I've got to say, you have one of my favorite research headlines that I've seen in a while. It reads, "Good luck figuring this one out." So you start with some history, which is, it's facts. You have a table that shows what happens when the GOP controls all three branches of government. Can you run through some of that for us?
Yeah, so you can see the data up on screen, and this is just purely based on what has happened in the past when we had GOP controlling all three components there. Decent stock market performance, not the best of any, combination. Little bit of an uptick in inflation, okay GDP growth. But of course, every year is different. And when you're talking about an every 4-year kind of thing, you're not talking about a huge sample size. So it was just a basis for, okay, what's happened. It was not meant to go in there as, okay, you can bank on this in terms of all these metrics, particularly in a year like 2025.
Yeah, of course. The statistical sample is pretty small, and also there's economic cycles that have nothing to do with policy. But let's talk policy briefly. We'll start with the good news. You say that tax cuts and deregulation could be a tailwind.
Yeah, except that they're probably more end of year. And for the most part, those require, certainly on the tax front, congressional approval. And the 2017 Tax Act doesn't expire until the end of the year, whereas policy proposals on tariffs and immigration, for the most part, can be done via executive order and are seen as something near term in terms of priority. So we've got a timing mismatch. And in the case of the deregulation and the tax cut side of things, yes, that's seen as pro-growth, but it's hard to argue against the combination at the extreme on tariffs and deportation. It's hard to argue against them putting downward pressure on growth and upward pressure on inflation. And I think that was reflected in some of the uncertainty that we got out of the December Federal Open Market Committee meeting and some of Powell's comments. I think there's just a lot of uncertainty that could be pretty big needle movers in terms of the growth trajectory and the inflation trajectory on those two policy areas of tariffs and immigration.
So thanks for that. How does this play out in the market? What do you see as, let's talk market overall, S&P 500. We've got a lot of momentum right now, which you point out, but also valuations are kind of steep, not a timing measure, but still expensive. And sentiment is awfully frothy right now.
Sentiment is frothy, and I think all else equal, that represents a bit of a contrarian risk and could help to explain why you saw such a negative market reaction while the December FOMC press conference was going on. I do want to point out, though, that there's been so much attention on the resilience of the market this year and how many record highs there were, but there's been really a tale of two markets in 2024. The first half of 2024, you were so dominated, the market was so dominated by the Magnificent Seven, it kept the cap-weighted indexes afloat, but there was a lot more churn and rotation under the surface. Then you saw a bit of broadening out from, call it mid-July up until the presidential election. But the point from the election going forward, even before that sell-off that kicked in with the FOMC meeting, you had the market still looking great, but the average member maximum drawdown in the NASDAQ had hit bear market level declines just from election day forward to the point where you and I are having this conversation. So I think to really understand what's going on in the market, I know I keep doing the air quotes, requires a lot more depth of analysis than just looking at what the cap-weighted indexes are doing or have done.
Yeah, that's a really important thing to point out. Thank you for that. So when investors are trying to figure out, okay, what do I buy now? You lay out various factors, not really so much sectors as factors of stocks that you think look attractive. I'm going to blow through a couple: improving profits, strong return on assets, balance sheet strength, ample interest coverage. Those all things sound like things you'd want at any time in the market. Why is now especially important to be looking at those factors?
Well, they are high quality factors, and you're right to suggest that, well, why wouldn't we always want to invest in high quality companies? But there are times where you actually want to go down the quality spectrum. You want to go into the more indebted companies, the weaker profitability companies, particularly if, say, you've come through a recession, you're coming out of a recession. That's where the leverage is to a big upturn in the economy. I just don't think we're at that point in the cycle, which is why you want to maintain that focus on quality, especially for investors that want to go down the capitalization spectrum, want to look for opportunities outside the mega cap, tech and tech related names, looking for those positive profitability trends, strength of balance sheet, high interest coverage, especially given how sticky longer term yields have been even in the course of this Fed cutting cycle. So yes, generally you want to buy quality, but there are specific reasons why in this backdrop you don't want to sacrifice that quality element.
Got it. If you're buying small caps, stick to the profitable ones. Liz Ann, thank you so much for coming on the show. We got to talk again in 2025.
Would love to. Thanks, Jack.